Hello and welcome to the first ACCA Exam 1 revision video. So ACCA 1 is actually a really long course in and of itself, just one part of the even bigger overall ACCA course. So what I've done is I've cut the whole thing down into small sections to help you revise for the course. Today we're going to start where we normally should when we're revising, right at the beginning, and we're going to look at organisations and stakeholders. At the start of the course, you are expected to know the different types of organisations that there are. So without further ado, let's get straight on to it. Right, the first thing you need to know is what type of companies exist. And broadly, companies can be split up into two parts: private companies and public companies. Now, private companies are 95% of all companies that exist within the UK, or anywhere else for that matter, bar North Korea. Private companies are companies or organisations that are not owned by a government, and their aims generally are to make a profit. Not always, in the case of NGOs, non-government organisations or charities, but most of the time a private company it exists to maximise its profits. Whereas a public company, by its very name, it is working for the public. It is working to provide a service, and the reason why a public company is doing that is because public companies are owned by the governments, either central governments like the UK government as a whole, or maybe local ones such as local councils or something like that. So the first thing to know is that we can split businesses up into private versus public, and the main aim of a private company is generally to make money, make profit, and make as much revenue as possible, so keep revenues high and keep costs low. But within private companies, there are a whole different load of legal ownership types. There are a huge amount of different types of private company. So let's start with a sole trader. Sole trader is simply a business that's owned by an individual, by one person. Now, sole traders are usually small in size, can sometimes be medium, but a sole trader is generally small because as it's run by one individual, there's quite a lot of risk on that one individual. That singular owner has unlimited liability, which means any debts the business incurs are also the debts of the owner. Therefore, it's in their best interest to really keep the business quite small, because as it grows, you take on more risk, and more risk on one person's shoulders can be a lot of stress. So generally, we tend to find that a sole trader is a company owned by one individual person, and it tends to be quite small. There are no shareholders in a sole trader because, again, it's just owned by one person. There's no shares involved in that whatsoever. Then we kind of tend to find that a sole trader may grow into a partnership. Not always. They may jump to limited companies straight away, but sometimes they can grow into partnerships. Now, legally, a partnership is between 2 and 22 people. That means that you can technically have 20 different owners, 20 different people who have to make one decision. So you can tell that's really going to slow the whole process down. Again, a partnership has unlimited liability, which means all of the partners within a company will share that liability. Again, no shareholders at all. We then move on to private limited companies. They're quite common here. And the word limited there is a clue. A private limited company means that the ownership of a company and the control of the company are separate. So it basically means that the debts of a company are separate to the people or person who owns that. Now, within private limited companies then, there are shareholders. Shareholders are people who own shares in a company. Within private limited companies, there's probably only going to be a few shareholders. And again, they're slightly different to the larger public limited companies. In private limited companies, you can only transfer shares, you can only sell shares if you have the consent of all the other shareholders. Within a private company, generally the directors also will own a lot of shares, unlike sometimes public limited companies. And within private limited companies, they generally get their source of funds from the owner or business associates or friends or venture capitalists, investors. Therefore, private limited companies do tend to be small to medium because it's quite hard for them to raise a huge amount of money because they're not on the stock market. So speaking of the stock market, we then bring ourselves to public limited companies. Now these are companies again where there are shares, but the difference with a public limited company is that anyone can own those shares. And not only can anyone own those shares because they are available to buy on the stock market, but they generally tend to be spread quite far and wide. Because they're available to everyone, you tend to get a lot of different shareholders, and only a few of them are going to own a major stake in the company. Shares in public companies can be offered to the general public, as I say, and that's usually through the stock market. So a public limited company does have the advantage that it can raise funds through selling shares on the stock market, so it can get that big amount of funding, that large amount, very quickly overnight by floating on the stock market. We then got NGOs, non-government organisations. Now, they vary slightly from your average private limited company because an NGO, standing for non-government organisation, it is a private company, but it's completely separate or completely away from government organisations. The reason why an NGO is maybe something different to a normal private company is because NGOs normally have some form of aim based around social, political, or environmental change. So they're like a charity, except they're not directly trying to just raise money. They maybe have some sort of social aim. NGOs are not linked with any particular governments, and they definitely don't have the aim of most private companies, which is to maximize their profits. Instead, NGOs do have that aim of save the rainforest, or raise awareness of domestic abuse, or getting cigarettes banned forever. Whatever it might be, that's what we would classify as an NGO. The United Nations, for example, can be classified as an NGO because it's not formally linked to any specific government. There are a few other types of business ownership, not as much mentioned, but still could come up. We've got cooperatives in which all of the workers of the company own a stake in the company. And we've got mutual associations in that members own the company again, but the slight difference there is that the customers there can also be involved and own part of the company too. You're then asked in the same section about stakeholders. And again, generally we can divide stakeholders into two sections, internal versus external. Internal stakeholders are anyone who works within a company, and external stakeholders are those who are outside of the company. A stakeholder is simply someone who is affected by a business. They don't have to work for them, but they will somehow be affected by them, either directly or indirectly. So if we start with internal stakeholders, your general internal stakeholders are going to be the owner, they're going to be managers, and they're going to be other general employees. Now, stakeholders in those roles, internal roles, generally they tend to have the interests of keeping their job, making sure the business is successful, earning a decent wage, getting a promotion, and being satisfied within work. They may be concerned when the business tries to make large changes because, as internal stakeholders, they might be worried about their jobs. They may be worried about having to relocate. They may be worried about being made redundant, for example. So internal stakeholders generally want to be paid well, they want to enjoy their work, and they don't like things that cause them to their job to be at risk. Obviously, managers, as opposed to general employees, have slightly different aims in that they want all of those things, well paid and the business to be successful, but also their aims are for the long-term objectives of the business to be met, because as a manager, that's essentially what you're doing, steering the ship. We then got external stakeholders. Now, external stakeholders are people who are completely outside of the business. That might be the government. That might be pressure groups who have an issue with the company and what they do. That could be professional bodies, people who maybe things like trade unions, for example. If the company we were talking about was a train company, then the trade unions for them would be a stakeholder. Now, generally, what those stakeholders want, because they don't work for the company, they don't really care about profits and things like that. What they care about is the company is acting in the right manner. So government wants the company to pay the correct tax. Pressure groups don't want the company to pollute. Professional bodies want them to look after the workers properly. Now, in between internal and external, we've got this sort of middle ground, which can be called connected stakeholders. They are part of a company in some way, but not directly. They're not actually working for the company, but they are directly affected by them. So connected stakeholders are going to be shareholders. They're going to be bankers, people who've lent money to the business, suppliers, and customers. Now, each of those will want slightly different things. The shareholder wants the business to be as successful as possible so that share prices go up and the shareholders get as many dividends as they can. The bankers, the people who've lent the money, they want the business to do well so that they can get their loans back. They want the business to be a safe and secure place to have lent money to. Suppliers, well, again, they want the business to be successful and grow so that they'll need the suppliers and they'll buy more supplies from them, but also so that then they can pay the suppliers for goods that they've already given them. And customers, well, they want to get the best utility out of the company and its products that they can, but they also want as cheap prices as possible. Now, that's a kind of whistle-stop tour there of stakeholders, and some stakeholders have more power than others. Clearly, your shareholders and your owners, for example, have much more power and say over a business than perhaps some smaller suppliers, some customers, or some low-level employees might have. Pressure groups, you could argue, have basically no control over a business, because a pressure group isn't a legal government-run organisation, it's an NGO. So that means that ultimately a business could, if they decide to, completely ignore those stakeholders, those pressure groups, and just get on with it. Stakeholders can run into conflict with each other in that they want different things, and so sometimes one stakeholder will want the business to act in one way and another stakeholder will want them to act in a different way. For example, shareholders essentially only care about profit. The more profit, the better. If the business announced that it was going to shut down one of its factories because it was being unproductive, then shareholders would be happy because in the long term they would hope this would increase profitability. On the other hand, employees and managers may be devastated because they may be made redundant. So you can see there that stakeholders can come into conflict with each other. And ultimately, it's going to be about which stakeholder has the most power that the business listens to. That brings us to the end of the first section. Well, in the second video, we'll look at some questions on the topics that we've covered.